What are the potential impacts and risks of a default on the U.S. government, businesses, consumers, and investors? A default on the U.S. debt would have catastrophic consequences for the nation and the world. It would mean that the U.S. government would not be able to pay its bills, including interest and principal on its bonds, salaries and benefits for federal employees and retirees, Social Security and Medicare payments, tax refunds, student loans, and many other obligations. A default would also undermine the trust and confidence in the U.S. Treasury market, which is the largest and most liquid debt market in the world. The U.S. Treasury market is the backbone of the global financial system, as it provides a safe haven for investors, a benchmark for interest rates, a source of funding for governments and businesses, and a reserve currency for central banks. A default would trigger a series of negative effects across the financial markets and the economy. Some of these effects are: a spike in interest rates. A default would increase the risk premium on U.S. debt, as investors would demand higher returns to lend to a government that cannot honor its obligations. This would raise the cost of borrowing for the U.S. government, as well as for businesses and consumers who rely on credit markets. Higher interest rates would also reduce the value of existing bonds, causing losses for bondholders. A plunge in stock prices. A default would cause panic and uncertainty in the stock market, as investors would fear a recession and a credit crunch. A lower stock market would reduce the wealth and confidence of households and businesses, affecting their spending and investment decisions. A depreciation of the dollar. A default would weaken the demand for the dollar, as foreign investors and central banks would lose faith in the U.S. as a reliable borrower and a reserve currency issuer. A weaker dollar would make imports more expensive and exports less competitive, hurting trade and inflation. A contraction in economic activity. A default would reduce the income and spending of millions of Americans who depend on government payments or work for the government. It would also disrupt the operations and services of many government agencies and programs that affect the economy. A default would also damage the creditworthiness and profitability of many businesses that rely on government contracts or loans. All these factors would reduce economic growth and employment. A loss of global leadership. A default would tarnish the reputation and credibility of the U.S. as a global leader and a model of democracy. It would undermine the confidence and cooperation of U.S. allies and partners on various issues such as security, trade, climate change, and human rights. It would also embolden U.S. adversaries who seek to challenge or undermine U.S. interests and values. In summary, a default on the U.S. debt would be a disaster for everyone involved. The government, businesses, consumers, investors, and the world at large. It would create chaos and instability in the financial markets and the economy, threatening the livelihoods and well-being of millions of people. It would also erode the trust and respect that the U.S. enjoys as a global power and a beacon of democracy. That is why it is imperative that Congress acts swiftly and responsibly to raise or suspend the debt ceiling before it is too late. The U.S. cannot afford to gamble with its future by risking a default on its debt.